and welcome to the Property Wealth Podcast. Today, we're diving into a really exciting topic that can have a huge impact on your financial future, the tax benefits of real estate investing.
Yeah, it's one of those things that can really get overlooked, but it's super important, especially for those of us over 40 who are looking to build long-term wealth.
Exactly. You know, real estate isn't just about buying properties and hoping for appreciation. There's a whole world of tax advantages that can work in your favor.
Right, and they can help you keep more of your hard-earned money. We're going to cover some key deductions, how to take advantage of depreciation, and even some strategies for minimizing your tax burden.
Plus, we'll share some real-life examples so you can see how these concepts play out in practice. It's all about making this information relatable and practical for you.
And remember, everyone's situation is different, so it's always good to consult with a tax professional. But we'll give you a solid foundation to start from.
For sure. So whether you're just starting out in real estate or you've been in the game for a while, understanding these tax benefits can really enhance your investment strategy.
Absolutely. Let's get into it, shall we?
Let's do it. So first off, let's talk about some of the major tax deductions available to real estate investors.
So, when we talk about the tax benefits of real estate investing, it's really about more than just the numbers, right?
Absolutely, Mike. I mean, for folks over 40, these tax advantages can be a game changer, especially when you're looking at retirement timelines.
Right, and let's face it, retirement can feel daunting. You want to ensure that you've got enough saved up to live comfortably, and real estate can be a solid part of that strategy.
Yeah, I think about it this way. When you invest in real estate, not only are you building equity, but you're also potentially lowering your taxable income, which is huge as you get closer to retirement.
Exactly. For instance, I remember working with a couple in their early 50s. They had a good amount saved in their 401k, but they were worried about inflation eroding their purchasing power.
Oh, that's a real concern these days.
For sure. So they decided to invest in a rental property. The beauty was, not only did they start generating rental income, but they also took advantage of tax deductions on mortgage interest and property depreciation.
Wow, that really helps offset their taxable income, doesn't it?
Yes, and it gave them a sense of security, knowing they had a tangible asset that could appreciate over time even as inflation rates fluctuated.
That's such a great point. It's like having a hedge against inflation, right?
Exactly. And then there's the emotional side of it. Many people feel better knowing they have something they can pass on to their kids.
Oh, definitely. I think about my parents and how they always wanted to leave something behind. Not just money, but a legacy.
Right, and real estate can provide that. I had another client who bought a multifamily property. They were able to live in one unit and rent out the others.
Smart move.
They were building their wealth while also creating a home for their family. And once the kids were older, they could either keep it as an investment or even pass it down to them.
I love that idea. It's like planting a seed for future generations.
Yeah, and it's a way to teach them about financial responsibility. These conversations around real estate can really open doors for the whole family.
And in today's market, with all the shifts happening, having that stability feels more important than ever.
Absolutely. The economic trends we're seeing right now, with uncertainty in the stock market and rising interest rates, make real estate a more attractive option for many.
So true. I mean, some people might feel overwhelmed by the complexities of investing, but the tax benefits can really simplify things.
They can. And let's not forget about 1031 exchanges.
Oh, those are fascinating.
Yeah, they allow you to defer capital gains taxes when you sell one investment property and reinvest the proceeds in another.
So essentially, you can keep your money working for you without those tax implications right away?
Exactly. And for someone over 40, that can mean a lot for your long-term wealth strategy.
It's like a little extra cushion.
Right, and it's especially important when planning for retirement. You want to make sure your money is working as hard as you are.
And I think it's also about peace of mind. Knowing you have a plan in place and that your investments are growing while minimizing taxes can really relieve a lot of stress.
It absolutely can. And let's not forget the flexibility of real estate. You can choose how hands-on or hands-off you want to be.
Yeah, some people love managing their properties, while others prefer a more passive investment approach.
Exactly. And with property management companies out there, it's easier than ever to get involved without the day-to-day hassle.
I think that's empowering for many listeners, especially those who may be balancing jobs and family commitments.
Totally. It's about finding what works for you and your lifestyle. And that's where the tax benefits come into play again.
Right, because if you can reduce your tax burden, you can reinvest that money into more properties or save it for retirement.
Yes, and it's not just about the now, it's about planning for the future.
So if someone is considering getting into real estate, now might be the perfect time to really dive in.
Definitely. With the current economic trends, understanding these tax benefits can help people make more informed decisions.
And having that knowledge empowers you to take action, right?
Exactly. So many folks think real estate investing is out of reach. But with the right strategies, it can be very attainable.
And a big part of that is understanding how to leverage these tax benefits effectively.
Well said. That's crucial for building long-term wealth.
So speaking of strategies, let's dive into some core strategies that can help listeners maximize their investment and really take advantage of those tax benefits.
So Sarah, when we talk about the tax benefits of real estate investing, it's really important to understand some core strategies that can help anyone get started. One of the first things that comes to mind is the 1% rule. That guideline that says if you can rent a property for at least 1% of the purchase price each month, it's worth considering.
Right, that's a pretty straightforward benchmark. I mean, if you buy a property for $200,000, you should aim for at least $2,000 a month in rent, right?
Exactly. And it's a quick way to gauge whether a property could be a good investment. But then, of course, you have to factor in other costs too, like property taxes, insurance, maintenance, all that stuff.
Yeah, and that brings us to the 50% rule, which is another handy guideline, right?
Yes. The 50% rule suggests that about half of your gross rental income will go to operating expenses. So if you're bringing in $2,000 a month, you might want to budget around $1,000 for those expenses.
That makes sense. So if you take the $1,000 you have left over after expenses, that's your cash flow before considering your mortgage payments?
Exactly. And it's a good way to see if the property is worth pursuing further. You might also want to look into the cap rate, which is the capitalization rate. It's a way to measure the return on investment.
How does that work then?
Well, you calculate it by taking the property's net operating income and dividing it by the purchase price. So let's say your net operating income is $24,000 a year, and you bought the property for $300,000. You would do $24,000 divided by $300,000, which gives you an 8% cap rate.
That's a solid return. And if the cap rate is higher, it generally means a better potential investment, right?
Exactly. But you want to compare that cap rate to similar properties in the area. If all the properties around you have a cap rate of 5%, then your 8% is something to pay attention to.
Got it. So it's about context. What other strategies should investors keep in mind?
Financing options are crucial too. There are a few ways to fund your investment. Traditional mortgages, private money lenders, and even partnerships can be viable paths.
And those all have different implications, like how much you're putting down and what your payment terms look like.
Right. With a traditional mortgage, you might be looking at a 20% down payment, but with a private lender or a partner, those terms can flex a bit more. It's all about what works best for you.
And I imagine understanding your credit score is also important when it comes to getting financing.
Definitely. Your credit score can significantly impact your mortgage rates. A higher score typically means lower interest rates, which can save you a lot over the life of the loan.
That's a good reminder. Now, what about the types of properties? Are there specific markets or property types that tend to be more favorable for tax benefits?
Absolutely. Single-family homes tend to be the most straightforward, but multifamily properties can offer more cash flow. Plus, you can take advantage of depreciation over time, which is a huge tax benefit.
Depreciation. That's such an important factor. Can you break that down a bit?
Sure. Depreciation allows you to deduct a portion of the property's value from your taxable income each year. For residential properties, the IRS typically allows you to depreciate over 27.5 years. So if you bought a property for $275,000, you could deduct about $10,000 a year.
Wow, that adds up. So it's like getting a tax break without having to spend any money.
Exactly. And then there are other deductions you can take, like mortgage interest, property taxes, and even certain repairs.
It sounds like there's a lot of potential to minimize your tax burden through real estate investing.
There really is. But it's also essential to keep track of everything, like your expenses and any improvements you make, because you want to maximize your deductions.
That sounds like a lot of paperwork. Is there a good way to organize that?
Yes, using accounting software or even a simple spreadsheet can help you keep everything in one place. Plus, it's a good idea to consult with a tax professional who understands real estate. They can help you navigate the specifics.
That's a smart move. I think a lot of people overlook that part. Now, what about evaluating deals? What's a simple checklist investors can use to assess potential properties?
A solid checklist would include things like location, price, condition of the property, potential rental income, and any necessary repairs or updates.
And what about market trends? Should those be part of the checklist?
Absolutely. Understanding the local market trends is vital. Check out vacancy rates, average rent prices, and even job growth in the area. Those factors can really affect your investment's performance.
That's a great point. So it's really about doing your homework before diving in?
Exactly. You don't want to rush into a purchase without knowing what you're getting into. And I think that's where a lot of new investors can trip up.
Speaking of tripping up, what are some common pitfalls we should be aware of in this process?
That's a great transition. One major pitfall is underestimating costs, not just the purchase price, but all those hidden costs like maintenance, repairs, and vacancy periods.
Yeah, it's easy to get caught up in the excitement and forget about those ongoing expenses.
Definitely. And also, failing to have a solid exit strategy can be a mistake. You need to know what your plan is if things don't go as expected.
That's a really important point. It's all about being prepared for the unexpected, right?
Exactly. The more prepared you are, the better your chances of long-term success in real estate investing. So let's dive into some common pitfalls that, a lot of investors, especially those starting out, tend to encounter.
Absolutely. I think the first one that comes to mind is over-leveraging. It seems so tempting to maximize your investment, but it can backfire quickly, right?
Yeah, for sure. I've seen investors get so excited about a property that they stretch their budgets. They take on way more debt than they can handle. It feels like a good idea until, unexpected costs crop up and suddenly they're underwater.
Exactly. Can you share a real-life example of that?
Sure. There was this couple I worked with a few years back. They found a fixer-upper in a great neighborhood and decided to finance it fully. They thought they could renovate it and flip it within a year. But, as you can guess, the costs of renovations skyrocketed. Then, they hit a few snags, and the timeline stretched way longer than they anticipated.
That sounds stressful.
It was. They ended up with a huge mortgage payment and no rental income to cover it. They learned the hard way that, having a buffer for unexpected expenses is crucial.
That's a great point. So, it's about being realistic with your budget, right?
Exactly. And speaking of things that can go wrong, bad tenants can be a major headache.
Oh yes, I can only imagine. What's your take on that?
Well, I had a client who was so eager to fill a vacant rental that they didn't do proper screening. They ended up with tenants who, let's just say they didn't pay rent on time or at all.
Yikes.
Yeah, it was a nightmare. They not only lost rental income, but also had to deal with property damage and eviction costs. It was a tough lesson that sometimes it's better to wait for the right tenant than rush into a decision.
So what should someone look for to avoid that situation?
Definitely do thorough background checks and check references. You want to look for red flags, like inconsistent income or a history of evictions. It's all about doing your due diligence upfront.
Makes total sense. And what about ignoring cash flow? That's another big one, isn't it?
Absolutely. Cash flow is the lifeblood of real estate investing. I had another client who was all about the property appreciation. They bought a place in a hot market thinking it was a sure win. But they didn't pay attention to the monthly cash flow.
What happened there?
Well, they ended up with a property that had high expenses. Maintenance, property management fees, all of that. They were shocked to realize that after all the costs, there was barely any profit left.
So focusing only on appreciation can be risky.
Definitely. You want to ensure your properties can sustain themselves financially, And that brings us to timing the market.
Oh, that's a classic mistake.
Right? Trying to time the market is like trying to predict the weather. It's just so unpredictable. I had another investor who waited for the perfect moment to buy, thinking prices would drop.
And what happened?
Well, by the time they decided to jump in, prices had actually risen significantly. They ended up paying way more than they would have if they had just bought earlier.
That's frustrating.
It really is. The lesson here is that, instead of trying to time the market, focus on the fundamentals of the property and your investment strategy.
And what about hidden costs? I mean, that's a biggie too, isn't it?
Absolutely. I've seen so many investors overlook things like property taxes, insurance, and maintenance costs. One client I worked with bought a property but didn't factor in the property taxes, which were much higher than they anticipated.
That must have taken a toll on their budget.
Big time. They realized too late that their ROI was much lower than expected because they hadn't done their homework on those additional costs.
So it's crucial to do a full breakdown of expenses before making a purchase?
Exactly. And always have a little cushion for the surprise costs that can pop up,
So if someone finds themselves in one of these situations, like over-leveraging or dealing with bad tenants, what are some first steps they can take to recover?
Great question. I think the first step is to assess the situation honestly. Look at your finances and see where you stand. If you're over-leveraged, maybe consider selling or refinancing to get some relief.
That makes sense. And for bad tenants?
Well, if you're already in that situation, it's important to follow the legal processes for evictions if it comes to that. But also, take a step back and reevaluate your screening process for the future.
Right, and really focus on your cash flow moving forward.
Exactly. Always keep an eye on your finances and adjust your strategy as needed. It's about being proactive instead of reactive.
Wise words, Mike. So to wrap this up, the key takeaways here are to avoid over-leveraging, be diligent with tenant screening, keep a close eye on cash flow, and know your expenses inside and out.
Yep, and remember that timing the market is less important than having a solid investment strategy.
Perfect. That gives our listeners a lot to think about as they move forward in their real estate journeys.
Definitely. And the next steps are all about learning from these experiences and being prepared for whatever comes your way.
Exactly. Let's keep building that wealth together.
Absolutely, Sarah. All right, so let's dive into some immediate steps you can take, right now to start leveraging those tax benefits of real estate investing.
Yeah, I think it's super important to keep it actionable, right? So if someone's just starting out, what's the first thing they should do?
Well, I'd say start by educating yourself. There are some great resources out there. For example, you could check out the book on rental property investing by Brandon Turner. It's practical and really breaks things down nicely.
Oh, I love that book. It's so approachable for beginners. And what about podcasts? Any recommendations?
Absolutely. You might want to listen to Asterisk Bigger Pockets podcast. They have tons of episodes that go into the nitty-gritty of real estate investing, including taxes, which is super helpful.
Definitely. And speaking of practical steps, what about analyzing deals? How can someone get started with that?
Great question. I recommend using the Bigger Pockets calculator or something like Deal Check. They're both user-friendly and can help you crunch the numbers on potential investments so you can see what the tax implications might be.
Right. And it's also about developing a habit, isn't it? Like setting aside time each week to analyze a deal or two.
Exactly. Just commit to analyzing one deal a week to start. It's a manageable goal, and it'll help you get more comfortable with the numbers and the process.
And that way, you're not overwhelmed, right? You're learning at your own pace. What about local resources?
Well, joining a local real estate meetup or a club can be a game changer. You'll meet people who are already doing it, and you can learn from their experiences and share tips.
That's such a good idea. Networking is key. Plus, you might find a mentor who can guide you through the process.
Yes. And don't forget about online tools like Zillow or Rentometer. They can help you understand market trends and rental prices in your area. It's invaluable when you're trying to figure out how to price a property.
For sure. And if someone wants to get deeper into the numbers, what tools would you suggest?
Besides those calculators, you might also want to look into using your local MLS if you have access. It gives you detailed insights into property sales, which is crucial for making informed decisions.
That's a really practical step. And for those who might feel a bit lost with all this information, starting with just one or two of these tools can help build confidence.
Definitely. Just pick one tool or resource to start with. You don't have to do everything at once. The key is to start where you are and build from there.
I love that. And it's also about setting realistic goals, right? Like maybe aiming to find one potential investment by the end of the month.
Exactly. And remember, analyzing deals isn't just about the numbers. It's about understanding the location, the market, and the potential for appreciation as well.
Right. So getting familiar with your local market is super important. Any apps or websites that can help with that?
Yes, definitely use apps like Realtor.com or Trulia. They can help you get a sense of what's available in your area and what similar properties are selling for.
And it's also about having that mindset of continuous learning, isn't it? Like, read articles, join forums, maybe even follow some real estate investors on social media.
Absolutely. Engaging with the community can provide you with a wealth of knowledge and different perspectives that might inspire you.
And don't forget to keep track of your progress, too. Maybe start a journal to jot down insights or lessons learned along the way.
That's a fantastic idea. It'll help you reflect on your journey and keep you motivated. Plus, it's rewarding to see how far you've come over time.
So, with these tools and steps, anyone can start to build their real estate investing knowledge and confidence, right?
Exactly. Just take it one step at a time. And remember, it's a journey. Each small action adds up to significant progress.
And that's really encouraging for anyone who's feeling a bit hesitant. So those are some practical first steps. Now let's bring this all together.
What a journey we've had today, huh? Just to recap some of the key points about the tax benefits of real estate investing.
Yeah, it's been really eye-opening. One major takeaway is how depreciation can really work in your favor, right? That can significantly reduce your taxable income.
Exactly. And then there's the concept of cash flow. It's not just about what you make from rent, but how those expenses can be deducted, which helps you keep more money in your pocket.
Right. And let's not forget about the mortgage interest deduction. It's a pretty big deal for many investors out there. It can really alleviate some of the costs associated with owning property.
For sure. And there's also the benefit of capital gains tax rates being lower for real estate. If you hold onto your property long enough, that can really add up when you decide to sell.
Absolutely. And all these benefits combined can really help you build long-term wealth, especially for those of us over 40 who might be looking to secure our financial future.
Yeah, it's a powerful tool. And I think it's important to remember that investing in real estate isn't just about the here and now. It's about setting yourself up for a comfortable future.
So if you found today's conversation helpful, don't forget to like and subscribe to the channel. And hey, we'd love to hear from you. Share your biggest takeaway or any questions you might have in the comments.
And if you know someone over 40 who's thinking about diving into real estate, share this episode with them. It could really make a difference in their journey.
Definitely. And next time, we'll dive into the 1031 exchange. That's a great strategy for deferring taxes when selling properties. You won't want to miss it.
It's going to be a good one. Thanks for joining us today. We appreciate you taking the time to listen.
Yeah, thank you so much. Until next time, take care and happy investing.